Stop. If your trading feels random, it's not bad luck. It's this one shift you're missing. Most traders think they need better indicators, tighter entries, more screen time. That's exactly why they stay stuck. There's a quiet shift happening in the market, and the traders who see it early start moving very differently and very profitably. Ignore it, and you'll keep chasing candles that were never meant for you. Watch closely, because in the next few minutes you'll understand the shift most traders overlook, and how to position yourself before the crowd catches on. Most traders think they need better indicators, tighter entries, more screen time. That's exactly why they stay stuck. Let me tell you something most men in this game learn too late. The market does not beat you because it is clever. It beats you because you are looking in the wrong place. You sit there watching your indicators, drawing your little lines, waiting for the perfect entry. I have seen thousands do the same, and yet the majority lose. Now ask yourself plainly, if everyone is staring at the same chart the same way, where do you suppose the real opportunity hides? You see, the shift most traders ignore is not on the surface of the chart. It is underneath the behavior. The tape, or what you now call price action, always tells the truth, but only to the man patient enough to read it without forcing his opinion onto it. Most traders believe their job is to predict. That is their first expensive mistake. The market is not asking for your prediction. It is asking for your observation. Have you noticed how often a stock moves before the news becomes obvious? How the smart money is already positioned while the public is still arguing in chat rooms? That is no accident. Money moves first. Stories come later. The shift, the one most ignore, is the moment when price stops behaving the way the crowd expects. It is subtle, quiet, easy to dismiss, and that is precisely why it pays. A stock that refuses to fall on bad news. A market that grinds higher while everyone calls the top. A breakout that holds when it should fail. These are not random events. These are footprints. But tell me, are you watching closely enough to see them, or are you too busy hunting the perfect setup? In my time, I learned that big money is never made in the obvious moment. It is made in the transition. The shift from weak hands to strong hands. Most traders buy strength after it is obvious. The professional begins watching when the character of the market starts to change. Do you know what I mean by character? It is the way price reacts to pressure. When selling comes in and the market shrugs it off. That is information. When good news cannot push price higher. That is information. Yet the average trader ignores these clues because they do not fit neatly into an indicator box. You must understand something if you intend to last in this business. Charts do not move markets. People do. Fear, greed, urgency, hesitation. These forces leave marks on the chart for anyone disciplined enough to read them. But that requires a shift in how you think. Most traders are hunting trades. The winning trader studies behavior. Which one are you doing right now? You see, wealth in trading is rarely built by the man who trades the most. It is built by the man who waits for the moment when the odds quietly tilt in his favor. And that tilt often begins long before the breakout everyone tweets about. I learned early, and paid dearly to learn it, that the market rewards patience far more than activity. There were times I made my year's profit in a handful of trades. Not because I was smarter, but because I waited for the shift, the moment when the market stopped acting weak and started acting strong, or the other way around. Most traders miss it because they are conditioned to react late. They want confirmation piled on confirmation. They want certainty in a game that offers none. And by the time they feel comfortable, the move is already well underway. Tell me, how many times have you entered a trade that looked perfect, only to watch it stall the moment you got in? That is not bad luck. That is timing without understanding. The shift I am speaking of often happens when the market feels most confusing. Volume behaves oddly. Pullbacks become shallow. Breakdowns fail to follow through. It feels messy, unclear, easy to ignore. But the trained eye sees something else entirely. It sees pressure being absorbed. It sees sellers running out of urgency. It sees buyers quietly gaining control. Now here is where the money mindset separates the amateur from the professional. Most traders need action to feel productive. They equate movement with progress. But in speculation, doing nothing at the right time is often the most profitable decision you will ever make. Can you sit still when nothing is clear? Or do you feel the itch to force a trade? Be honest with yourself. Because the market has a way of charging tuition to the impatient. Wealth building through trading is not about catching every move. It is about aligning yourself with the meaningful ones, the moves born from real shifts in supply and demand. And those shifts rarely announce themselves with fireworks. They whisper first. A tight range that refuses to break down. A trend that survives repeated tests. A pullback that lacks conviction. These are the early signals. The quiet clues. But here is the uncomfortable truth most traders avoid. Seeing the shift requires emotional control. You must be willing to look wrong before you are proven right. You must tolerate uncertainty while the crowd demands clarity. And you must manage your risk like a businessman, not gamble like a hopeful spectator. Do you approach the market like a patient operator or like a man chasing excitement? Because the market knows the difference. The traders who build lasting wealth are not the ones with the fanciest systems. They are the ones who understand when the market's character begins to change, and who have the discipline to act only when the evidence quietly stacks in their favor. Most men come into this business believing the signal comes first and the move comes second. That belief costs them money for years. The truth, the one the market quietly demonstrates day after day, is that behavior shifts long before your neat little indicators decide to wake up. You have probably seen it yourself and dismissed it. Price starts acting different. Not dramatic, not obvious. Just different enough to make you uncomfortable. The trend that was falling suddenly refuses to drop easily. The rallies that used to fail quickly begin to hold a little longer. Nothing on your screen flashes green or red yet. No clean setup. No textbook pattern. So you ignore it. Most traders do. But the professional knows that markets, like people, change their behavior before they change their direction. The chart is not just lines and candles. It is a record of pressure. Buying pressure. Selling pressure. Urgency. Hesitation. Have you ever watched a stock that should have dropped on bad news, but didn't? That is not noise. That is information. When supply is supposed to overwhelm demand, and yet price refuses to collapse, something underneath is shifting. Stronger hands may be quietly absorbing shares. Weak sellers may be running out of conviction. The crowd does not see it yet because the obvious breakout has not occurred. But the shift has already begun. The average trader waits for confirmation because confirmation feels safe. Indicators crossing, patterns completing, volume spikes. By the time all the lights turn green, the easy part of the move is often already behind you. Now I am not telling you to guess. Guessing is expensive entertainment. What I am telling you is to observe the market's behavior before you demand a formal signal. There is a difference. Consider how a healthy uptrend behaves. Pullbacks are orderly. Buyers step in consistently. Bad news gets shrugged off. The market feels supported. Then, gradually, something changes. Pullbacks get sharper. Rallies struggle. Support levels start getting tested more often. Nothing has broken yet, but the character is changing. Do you see how important that is? Most traders are trained to react after the break. The professional begins preparing during the shift. That preparation is where the edge lies. I learned long ago that markets telegraph their intentions through subtle behavior long before the crowd notices. The difficulty is not in seeing it. The difficulty is in trusting what you see without forcing a trade too early. Because here is the trap. Many traders notice something feels off, but instead of observing patiently, they jump in prematurely. They try to be first instead of being right. That is just another form of impatience wearing a smarter hat. You must develop the discipline to watch the shift unfold step by step. When selling pressure comes in, does price slice through support? Or does it stall and bounce? When buyers push higher, do they get immediate follow-through? Or does the move fade quickly? These reactions tell you far more than any static indicator ever will. Think about your own trades for a moment. How many times have you entered on a perfect-looking signal only to watch the trade go nowhere? Or worse, Reverse slowly while all your indicators still looked fine. That usually means the behavior had already shifted. And you were late to notice. The market rarely rings a bell at the exact turning point. It transitions. Quietly, unevenly, sometimes frustratingly. That messy middle is where most traders lose interest, and where the observant trader begins to lean forward. Because the shift most ignore is rarely clean. Volume might dry up, volatility might contract, price might start respecting levels it previously ignored. These are small things, easy to dismiss if you are only hunting obvious breakouts, but fortunes are built by those who respect small changes early. You see, wealth in trading does not come from reacting the fastest. It comes from interpreting the market more accurately than the crowd. And accuracy begins with behavior, not signals. Signals are lagging confirmations of what behavior has already revealed. Once you truly understand this, your entire relationship with the chart begins to change. You stop asking, "Is this a buy signal?" and start asking, "What is the market quietly telling me right now?" That is a very different question. And the traders who learn to ask it consistently start seeing opportunities long before the crowd feels comfortable enough to act. The crowd reacts to price. That is the first thing you must accept if you intend to survive in speculation. Most traders sit in front of their screens waiting for price to move so they can feel something. Excitement, fear, urgency, and then they act. By the time emotion hits them, the move is already in motion. The professional does something very different. He studies the character of the market before he commits his money. Now, what do I mean by character? I am not speaking in poetry. I mean the way price behaves under pressure, the way it responds when buyers push, the way it reacts when sellers lean in, the tone beneath the movement. Have you ever noticed how two charts can look almost identical on the surface, yet one follows through beautifully while the other collapses? Most traders never ask why. They see a breakout, they click buy. They see a breakdown, they click sell. Their entire process is reaction. Price moves first, they move second, and they wonder why the market always feels one step ahead. Because it is. The crowd is predictable in one very reliable way. It waits for comfort. It waits for the move to look obvious. It waits for agreement. And by the time agreement arrives, the professionals have often already built their positions quietly. You must train yourself to stop reacting like the crowd. When price pushes higher, do not ask only, "Is it going up?" Ask instead, "How is it going up?" Is the move smooth and persistent, or choppy and hesitant? Are pullbacks shallow and quickly bought, or are they deep and labored? Does volume expand on strength and dry up on weakness? These details matter more than the direction alone. I learned long ago that markets speak through behavior long before they speak through headlines or clean patterns. The difficulty is that behavior requires interpretation, and interpretation requires patience. Two things the average trader avoids. Tell me honestly, when you look at a chart, are you studying it, or are you hunting for a reason to click? Because there is a difference, and the market charges heavily for not knowing it. The crowd loves obvious momentum. It feels safe to buy when price is already running. It feels logical to short when the chart looks weak. But the professional watches for something more subtle. He watches how price behaves when it is supposed to do something obvious. For example, when a market breaks out and immediately stalls, that is information. When a stock sells off sharply and then refuses to continue lower, that is information. These moments reveal the internal struggle between supply and demand. But the crowd rarely studies this struggle. It reacts emotionally to the surface move. You see it every day. Price spikes and traders rush in late. Price dips and traders panic out near the bottom. It is not because they lack intelligence. It is because they are emotionally synchronized with the crowd instead of analytically aligned with the market. That is the quiet danger. If you allow price to trigger your emotions first, your decisions will always lag the real opportunity. The professional reverses this order. He studies first. He interprets second. He acts last. Do you notice how different that rhythm is from the average trader? Character reading is not about predicting the future with certainty. Nothing in this business offers certainty. It is about recognizing when the market is behaving normally, and when it is not. When a strong trend suddenly struggles to make progress, something is changing. When repeated selling fails to push price lower, something is changing. These shifts in character often appear before any traditional signal confirms them. But here is where most traders lose their footing. Reading character requires emotional neutrality. You cannot do it well if you are desperate to be in a trade. You cannot do it clearly if you are afraid of missing out. The market's behavior is subtle, and subtle things are invisible to the impatient eye. That is why the crowd keeps reacting while the professional keeps observing. Over time, if you study enough charts with the right mindset, you begin to feel the difference between healthy movement and forced movement, between real demand and temporary excitement, between quiet accumulation and noisy speculation. This is not magic. It is pattern recognition built through disciplined observation. And once you start seeing it, something uncomfortable becomes obvious. Most of the market's biggest clues appear while the crowd is still emotionally chasing the last move. Most men in this game pay far too much attention to the news and far too little attention to what price does after the news. That habit has emptied more trading accounts than bad luck ever could. You must understand something early if you intend to last. News does not move markets. Reaction to news moves markets. There is a world of difference between the two, yet the average trader treats them as the same thing. He reads a headline, forms an opinion, and rushes to act. By the time he clicks his order, the market has already weighed the information and moved accordingly. Tell me, how many times have you seen, great, news come out, and the stock falls anyway, or terrible news hits the wires and price barely budges? That is not irrational behavior. That is the market speaking clearly, if you are willing to listen. The professional does not argue with the news. He watches how the market digests it, because price reaction reveals the true balance between supply and demand far better than any headline ever could. Consider this carefully. If bullish news cannot push a stock higher, what does that suggest? It suggests that buyers are already exhausted, or that stronger sellers are quietly distributing into the strength. On the other hand, if bad news fails to drive price lower, it often means the selling pressure is being absorbed by stronger hands. This is the shift most traders overlook. They focus on what the news says instead of what the market does. I learned early, and only after paying the market's tuition, that the tape never lies, but opinions often do. News is interpreted through emotion. Price is the final vote. You must train your eye to study the vote. When earnings come out, watch the first reaction. Then watch the second. The first move is often emotion. The second move is often information. Does the stock hold the gain? Does it fade slowly? Does it reverse sharply? Each behavior tells you something about who is truly in control. But most traders never wait long enough to find out. They see a headline and feel urgency. They feel they must act now or miss the move. That urgency is precisely what places them on the wrong side of the trade more often than they care to admit. Have you ever jumped into a trade on news, only to watch the move reverse slowly and painfully? That is the market teaching a lesson many refuse to learn. The professionals, the men who build real wealth in speculation, often do the opposite of the crowd around major news. Not because they are reckless, but because they are watching behavior instead of reacting to emotion. They ask quieter questions. Is the market accepting the news or rejecting it? Is volume confirming the move, or is the move struggling to gain traction? Are pullbacks shallow and supported, or deep and heavy? These are the questions that matter. In my experience, the biggest opportunities often appear when price behaves contrary to the obvious interpretation of the news. That is when something beneath the surface is shifting. That is when strong money may be positioning while the public is still reacting emotionally. But make no mistake, this requires patience and restraint. You cannot trade every headline. You cannot assume every unusual reaction is meaningful. The market is a weighing machine over time, and sometimes it takes a little while for the true intention to reveal itself. That is why observation must come before action. Most traders are too eager to feel smart. They want to predict what the news will do. They want to be early, impressive, decisive. The market has little interest in rewarding that kind of impatience. It rewards the man who waits to see how the crowd behaves, and then studies whether that behavior is being confirmed or quietly absorbed. Think about your own process for a moment. When major news hits, do you feel pressure to act immediately? Does your pulse quicken? Do you feel the fear of missing the move? If so, you are experiencing exactly what the crowd experiences. And the crowd, as history has shown again and again, tends to pay for its urgency. Wealth in trading is rarely built on emotional reaction. It is built on calm interpretation. The chart after the news often tells a far more honest story than the news itself. Price either follows through, or it does not. And when it does not, when the market refuses to behave the way it should, that is when the observant trader begins to pay very close attention. Patience during market transitions is one of the rarest advantages a trader can possess, not because it is complicated, but because it runs against human nature. Most men come into this business believing success comes from action, fast decisions, quick entries, constant engagement. The market has a quiet way of punishing that belief. The truth is simpler, though not easier. The big money is usually made during the waiting. You see, markets spend far more time transitioning than they do trending cleanly. They shift from accumulation to markup, from distribution to decline, from strength to hesitation and back again. These in-between phases are where most traders grow uncomfortable. The movement feels unclear. The signals look mixed. Nothing seems urgent enough to justify bold action. So what does the average trader do? He forces a trade. He tells himself he sees something. He convinces himself the setup is close enough. He would rather be wrong in motion than patient in uncertainty. That single habit, the need to act when nothing is truly aligned, drains accounts slowly and consistently. Now ask yourself plainly, how often do you trade because the market is ready, and how often because you are tired of waiting? There is a difference, and the market knows it. During transitions, price often behaves in ways that frustrate both buyers and sellers. Breakouts fail to follow through. Breakdowns recover unexpectedly. Volatility contracts. Volume becomes uneven. It feels messy, and the human mind dislikes messy environments. But to the trained trader, this mess is information. A transition is the market's way of redistributing risk and positioning. Strong hands are testing the waters. Weak hands are being worn down. The outcome is not yet obvious, and that is precisely why patience becomes so valuable. Most traders lose money not because they cannot recognize trends, but because they cannot sit still while waiting for one to properly emerge. I learned this lesson the expensive way. There were times I entered early because the setup looked promising, only to watch the market drift sideways for days or weeks. My analysis was not always wrong. My timing was impatient, and impatience in speculation is simply another form of poor risk management. Have you noticed how often the market rewards the trader who waits for clarity rather than the one who anticipates it? It is no coincidence. Patience is not passive. It is active observation without unnecessary commitment. While the crowd grows restless, the disciplined trader studies the character of the market. He watches how price reacts to tests. He notes whether support holds more firmly than before. He observes whether rallies are gaining sponsorship or losing momentum. These small observations compound into clarity, but only if you give them time to develop. Most traders never allow that time. They feel the need to participate constantly, as if sitting in cash were some kind of failure. In reality, sitting in cash during uncertain transitions is often the most professional position you can take. Cash is a position. Do you treat it that way? The market pays a premium to the trader who knows when not to play. During transitional phases, risk often outweighs reward because direction has not yet proven itself. The range can be wide enough to trigger stops but not strong enough to sustain trends. This is the environment where overtrading quietly compounds losses. Patience protects capital, and in this business, capital is opportunity. Without it, even the best setup becomes meaningless. Now understand this clearly. Patience does not mean hesitation when the moment finally arrives. When the transition resolves and the market shows its hand, the professional acts decisively. He has waited. He has observed. He has preserved his resources. Now he can press his advantage with confidence. But that confidence is earned during the waiting period. Tell me, when you review your losing trades, how many were taken during clean, obvious trends, and how many were taken during choppy, uncertain transitions? Most traders discover an uncomfortable pattern when they look honestly. The market does not demand constant action from you. It demands correct action at the correct time. Those are not the same thing. One is driven by emotion, the other by discipline. Patience during transitions sharpens your timing, protects your capital, and keeps your judgment clear. It allows the market to reveal its intentions instead of forcing you to guess them. And the traders who truly learn to sit quietly while the market sorts itself out begin to notice something the restless crowd keeps missing. Most losses in speculation do not come from one catastrophic mistake. They come from something quieter, more persistent. Too much activity without enough alignment. The average trader believes he is losing because he picked the wrong stock or the wrong entry. Very often, the real problem is simpler. He traded when he should have waited. There is a dangerous illusion in this business that productivity equals profit. It does not. In most professions, effort and output move together. In trading, effort and results often move in opposite directions. The harder a man feels he must push, the more likely he is forcing trades the market never invited him into. Have you ever looked back at your trades and noticed how many were taken simply because you felt you should be doing something? Be honest. The market does not pay for business. It pays for timing and alignment is rare. That is the part most traders fail to respect. You see, high probability conditions do not appear every hour, every session, or even every week. Markets breathe. They expand, contract, trend, and stall. But the average trader sits in front of the screen expecting opportunity to appear on demand. When it does not, impatience begins to whisper. Maybe this setup is good enough. Maybe the move is about to start. Maybe I should just take a small position. Those maybes are expensive words. In my experience, the majority of losing trades were not the result of poor analysis. They were the result of trading during mediocre conditions. The setup was not fully aligned. The market was not fully committed. But the trader was tired of waiting, so he acted. The professional thinks differently. He understands that every trade carries friction, spreads, slippage, emotional energy, opportunity cost. He does not deploy capital unless the potential reward clearly justifies those costs. Now let me ask you something plainly. Do you measure your success by the quality of your trades or by the number of them? Because the crowd loves action. It feels productive. It feels engaged. But frequent trading during low-quality conditions slowly bleeds an account in ways that are difficult to notice day by day. Losses stack quietly. Confidence erodes slowly. Discipline weakens gradually. And before the trader realizes what has happened, he is fighting uphill just to recover. Overtrading is rarely loud. It is subtle. It disguises itself as effort. It tells you that more screen time will fix things, that more setups will improve results. But the market does not reward effort. It rewards selectivity. Wealth in speculation often comes from a handful of well-timed decisions, not from constant participation. I learned this the hard way. There were periods when I traded too frequently, not because the opportunities were abundant, but because I was mentally restless. I wanted involvement. I wanted movement. The market, being the great teacher it is, charged me accordingly. Only when I began to respect alignment, real alignment, did my results stabilize. Alignment means the trend, the behavior, the volume, and the broader market tone are all telling the same story. It is not perfect certainty, because that does not exist. But it is a stacking of evidence strong enough to justify risk. Most traders do not wait for that stack to build. They trade the first hint instead of the confirmed shift. They enter on anticipation instead of participation, and then they wonder why the market feels inconsistent. Tell me, how often do your trades feel rushed? How often do you enter and immediately feel uncertain? That feeling is rarely random. It often appears when action outruns alignment. The patient trader grows comfortable doing nothing when conditions are unclear. He does not measure his day by trades taken. He measures it by decisions avoided when the odds were not favorable. That mindset protects capital. It also preserves emotional clarity, which is just as important. Because every unnecessary trade consumes attention, confidence, and discipline. By the time a truly high-quality opportunity appears, the overactive trader is often mentally and financially depleted. The selective trader, however, is fresh, focused, ready. He has been waiting. This is why the shift from activity to alignment is so powerful. It changes the entire rhythm of your trading. You stop chasing movement and start evaluating conditions.